Well, I think it shows that the decision not to taper was quite a close call. I think that's the phrase that they're using. And when we look forward, we're now of the view, given the government shutdown and therefore the lack of economic data from the United States, that the committee is actually unlikely to taper even later this year at the December meeting. And so tapering is still on the agenda. We know the FOMC wants to adjust monetary policy, but it's probably on the agenda for the first quarter of next year rather than this year. Well, you could argue that in terms of that linkage to the decision to taper, it's giving some breathing room. If we look at the really acute issues that countries were suffering in the third quarter, particularly what we call the fragile five, it was one of a situation of dollar strength, a very rapid backup in US bond yields, which was the result of a perception that the Fed was about to taper in September, and also that the US growth was really building momentum. And indeed, we saw a string of good numbers, particularly around the labour market. Now, of course, we simply don't know where the US economy is. There's still some private data vendors that are producing data. But we know government shutdowns have affected consumer sentiment in the past and the consumer behaviour. And it probably will affect, at least in part, our thesis around corporate capex in the United States driving the next leg of the recovery. But we won't know for sure how this has affected the US for some time. So it buys a bit of time. It's actually probably net a positive for the fragile five. But longer term, the fundamental picture still remains that growth in these countries, it includes India, Indonesia, South Africa, Brazil, Turkey, is still very weak. We still have macro imbalances to close. Inflation is still structurally too high, so there's a problem around underinvestment in the supply side. And essentially, we would continue to be quite cautious on the long-run equity market outlook. No, they're not. I think very few people in financial markets would view that as an inevitable outcome, i.e. going beyond the 17th in terms of the debt ceiling. Clearly, the United States Treasury Secretary has indicated that that is an important date, though some of our own work suggests that they might be able to manage until really the very end of the month when certain bond coupon payments become due, and then of course we have Social Security checks that have to be sent out. But I do think if we're not resolved this by the middle of next week, the level of tensions in financial markets will ratchet up further. We've already seen volatility, the VIX, pick up. We've seen some very abnormal pricing at ultra-short maturities in Treasury bills. So it is a risk issue for global financial markets. Well, there are themes in the developed world which we like better than the overall situation in EM. Europe's economy is gradually picking up. We're forecasting Germany and the United Kingdom in particular to have much faster growth next year than this year. And when we look at Japan, also there is an underlying theme there in Abenomics and a very strong series of data that we're getting, particularly on the corporate investment side, machinery orders, the Tankan survey and the like, that represents a real positive investment theme. And so you're right that there is still a pretty abundant liquidity in the financial system, but the stock market performance shows that it's moving towards those areas that have a more positive macro and micro story to tell than much of the emerging world.